Welcome to this tutorial. In this tutorial, you'll see that the focus is very much a discussion type question. It's not unheard of to have a test where the entire test is just discussion. It's not as common necessarily, but it's not unheard of. And I deliberately also created this sim test to give you guys an opportunity to see discussion questions and to get a little bit more familiar with it. Because discussion questions are typically the type of questions where students tend to struggle the most. What I hope you'll see with the discussion question is that it really comes down to writing down the calculations that you perform and explaining why you would usually do those calculations. So when we're doing capital gains tax and we say capital gain is calculated as proceeds minus base cost, the discussion question is basically telling you that you need to say how the capital gain is calculated. It is calculated by calculating the proceeds amount and deducting from it the base cost amount. It really comes down to building it up. And of course, very important, this is where you have to go back to your theory. So where students, especially students who study only from questions, start to fall flat with discussion questions, it's because they make up their own rules about what the theory is, and then this is where it catches them. So you really need to know your theory to do a discussion question. And yes, it is more difficult. It definitely is more difficult, and it's hard to get 100%, but you should always be able to pass it if you know your theory. If you're not passing discussion questions, obviously there might be some form of exam technique, but most of the time it's because you're not writing down the theory, you're not stating and applying the theory. So before we continue here, again guys, as always, it's important for you to attempt this question yourself first. When I go through it now, it's always going to look easier. So you need to attempt it yourself first, mark it, see where you've gone wrong so that you can use this tutorial to your benefit. I'm not going to write out every single sentence. The solution is very detailed, so mine is more going to be about discussions, showing you what is the type of things that we have to think about in order to put it down. Okay, so let's start looking at it. So it says, question number 1, 20 marks, Artent Limited, which we'll just call Artent from this point onwards, is a registered Category C VAT vendor. Now, Category C VAT vendor, remember, Section 27 of the VAT Act gives us all the categories of VAT vendors. Category C VAT vendors means that it is a monthly VAT vendor. So what does that mean? It means every month they have to submit a VAT return. Why is that important for you? If I, in an exam, give you the information for January, February, and March, for example, and I tell you this is a Category C VAT vendor and you need to do the VAT return for March, you need to know that you will only include the March information. If this was a Category A or Category B VAT vendor, whichever one, a Category B, or let's say a Category A VAT vendor, it would mean you would do it for February and March if I ask you for the VAT return. So you would have to include February and March's details because it's a 2-month VAT vendor. So it's important to pay attention to that. Alright, so it's a Category C VAT vendor with a 31 December year end. Always pay attention to that. It means the tax year runs from the 1st of January until the 31st of December. That is the income tax year. Obviously not for VAT purposes. VAT in this case is a monthly one, like we said. And they say Artent only makes taxable supplies for VAT purposes. Now remember, that's also very important. Taxable supplies, remember you get 2 types. You get 0 rated, that is a taxable supply, and you get our standard rated ones, which is the ones at 15%. Those are both taxable supplies. Exempt supplies are not taxable. So what they're trying to tell you is that they don't have any exempt supplies. They might have 0 rated supplies and they might have standard rated supplies, but they don't have any exempt supplies. Why is that important, guys? That has to affect your apportionment. Okay, so here's the scenario 1, and let's start seeing what they're talking about here. Scenario 1. The company had purchased a vacant piece of land in 2005 for 513,000 rands, including VAT, with the intention to erect a warehouse. So there's a piece of land, they buy it because they want to build a warehouse on it. There's VAT was on the in the price. Could they claim it? Yes. Presumably everything's the same as it is now. They would have been able to claim it. Then in 2006, the company erected a warehouse on the piece of land at a cost of 4,560 million, including VAT again. So would they be able to claim the VAT? Yes, they would. And they say they used the warehouse to store its trading stock. Now, that is important. In this case, we know everything that this company does is a taxable supply. They only make taxable supplies, but it's important for you to understand that they use this in the production of income, for income tax purposes. They're using this for taxable supplies for VAT purposes. Okay, so they are using it. It's not that they're a company and they bought this for some other reason, a non-taxable reason or anything like that. Okay, then on the 10th of April 2022, arsonists set fire to the warehouse. The resulting blaze destroyed the warehouse and all the trading stock it contained. Okay, that's a shame. Artent submitted a claim to its insurers on the 11th of April 2022, and on the 22nd of May 2022, after investigating the incident, the insurers deposited 5.3 million rands into Artent's bank account. So they received this amount in their bank account. And I tell you, this amount comprises 4.95 million in respect of the warehouse and 350,000 rands in respect of the trading stock that was destroyed. Okay, so there's a lot of things actually happening here, a lot of things to consider. So the first thing I want you to see is, over here, when these arsonists set fire to it and the warehouse is destroyed, that is a disposal. Right, for things like CGT purposes. Any situation where you had an asset and now you no longer have an asset, or you're no longer using an asset, it's a disposal. Right, so you can go and see that in paragraph 11. That's the destruction of an asset. Okay, that's for CGT purposes. For VAT purposes, there's nothing that happens exactly at this point. But for VAT purposes, when you receive an amount from your insurers, like you get here, section 8.8 will pop up and tell you that this is a deemed supply. Now remember, when there's a deemed supply, it means there's a supply. So you have to calculate output tax. Now let me just remind you why I'm saying this about the deemed supply and so forth. Okay, important. Section 7.1a of the VAT Act tells us that you must calculate VAT. So this is now output VAT. Okay, so I'm just going to call it output tax. That's the correct term, but understand you must calculate VAT if there's a supply by a vendor of goods or services in the furtherance of an enterprise. Now, furtherance of an enterprise means it's for taxable purposes, it's for your normal business, it's not for exempt supplies. Now, why is this important? Because Section 8.8 tells you that there's a deemed supply, and they tell you it's a deemed supply of services. So there's a supply of services that you can tick off. This place is a vendor, and this happened, unfortunately, in the course of their business. They didn't. This happens. It's an accident or this malicious act by someone, but it's in their business. So it means all of these requirements are met. So that means we must calculate output tax. Now remember, the amount that they receive in their bank account, basically that times the tax fraction, will be the output tax that is calculated. Now for Section 8.8 also, it tells you if the insurer gives you a new asset, so it replaces the asset, then there's no deemed supply. In this case, that's not the case if you receive money. So from Section 8.8 perspective, there will be VAT implications. From an income tax perspective, what happens from an income tax perspective? Now remember, the moment that you receive anything for income tax purposes, receive money, your mind should immediately start asking the question, is this going to be subject to gross income? Okay, that is the exam technique that you need to have. So, is it going to be subject to gross income? Now, gross income says is the total amount in cash or otherwise received by or accrued to a resident during the year of assessment excluding capital nature. I'm going to just say here, including the special inclusions. Remember, special inclusion is something you have to consider. It's also given to us in Section 1, the Section 1 definition. You need to immediately, whenever you see any amount being received by a taxpayer, you need to think about this. And this, guys, counts for everything that you study in tax this year. So when it's insurance, when it's a salary, when it's interest, when it's a dividend, when it's royalties, when it's whatever amount it might be, you always have to go and ask yourself, is it gross income? So sometimes the answer is quite quick. We know if a sale is gross income. We know a salary that you receive is gross income. But sometimes it can be a little bit more complicated. But this is how they test gross income in exams. So you need to ask yourself, will this amount that we receive for the warehouse, will that be gross income? Will this amount for the trading stock be gross income? Now, if you know your rules, and you know your theory quite well, you'll remember that they have this whole discussion about does it fill the two situations, a revenue hole or a capital hole. If it fills a revenue hole, it's gross income. And if it fills a capital hole, it's capital in nature. So a way of thinking about it, what I would say, is you ask yourself, if this was the amount that they received for selling that asset, would it be gross income or would it be capital nature? And that will determine this. So what do you think already? I hope you all identified this. What's the warehouse? It's usually going to be capital because we're not in the business of buying and selling warehouses. Trading stock, that is usually what we sell. That's our business, our scheme of profit making. So that's usually gross income. Right. So you can already see just from this information, there's a lot of things popping out. And hopefully you got all of those. Right, then let's look at scenario 2. After the fire destroyed the warehouse that we just saw, the management of Artent decided to sell the property. Now remember what this means is this warehouse was on a piece of land. That's what they bought it on. So now they're saying they want to sell that property because the warehouse is gone. On the 1st of July 2022, Artent sold the land to Mr. Clifford Switz, a resident of Switzerland who is not a South African VAT vendor who plans to erect a factory on the property. Okay, now the fact that he's not a South African VAT vendor is not the end of the world. Even if you sold it to a normal person on the street that is a South African resident, so for example, if they had to sell it to me, I would also not be a South African VAT vendor. So that doesn't mean when you see things like that, don't immediately start panicking. Sometimes it's just information. Sometimes it's also to just make you feel a little bit uncomfortable. Where it could be relevant is that if we're looking at a thing like a going concern, for example, both of them must be vendors. Right, so, but that's not the case here. This is a piece of land. We're not selling a business, it's just land. And they say this guy wants to erect a factory on the property. Okay, cool. So Artent agreed to sell the land for $510,000. Make sure you see this is excluding VAT. In terms of the sales agreement, Mr. Swiss would be required to make the following payments. And they give us, he has to pay 40% on the 1st of July, 30% on the 1st of September, and 30% on the 1st of November. Okay, now, important here, when you sell the land for VAT purposes, does it meet these requirements? Because if it meets these requirements we saw over here, then there must be output tax. Is there a supply Yes, remember supplier is a service rendered or goods sold. Is it a vendor? Yes. The land is goods, and this is for our business. This is, part of our business. So yes, we will have to calculate output tax. Okay, so I want you guys to see how it keeps popping up. So I'm going to make the comment here, must calc output tax. Now, because this is excluding VAT, it would be 510,000 times 15%. Okay, you have to be sure also, if I just take you back, that you always pay attention to whether it includes or excludes VAT. Okay, 510,000 times 15%. Now, this is the sale of fixed property. So, for VAT purposes, fixed property, the timing rule, there's a special timing rule in section 9(3)(d) that says it is the earlier of payment or registration. But you'll remember also from your studies that fixed property works a little bit different, because then section 16 pops in. And section 16 then says, okay, we know this is the timing, but when must you actually account for the VAT? Now, we often see section 16(3), which is when you purchase the fixed property. But in this case, we are not purchasing the property. In this case, we are doing what? We are selling the property. So section 16(4) says, account for output tax when payment is received. So on each of these dates, you have to account for output tax. They tell you it was registered on his name on the 1st of August 2022. And I'm going to make the comment here, and hopefully you will remember this yourself. This does not matter to the seller. We are the seller in this case, Artent. It only matters when you are the buyer, and then only if you are buying it from a person that did not raise output tax on fixed property. All of these rules I'm saying to you now, if that doesn't come to you immediately like this, click, 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 then you have to go back and revise the fixed property rules. It's tricky, guys. It is a tricky part of that. Okay, so please revise it. So this is from VAT what we discussed. From income tax perspective, what do we think is going to happen there? Again, you receive an amount, so we have to think about gross income. Is it a total amount of cash? Otherwise, it's cash. It's received by them. They're a resident at the end of the year. Is it capital in nature? So, the selling of the property here, the land, how does it feel to you? Is it going to be in a scheme of profit making? Because then it's gross income. Is it the tree or the fruit that you're disposing? All of those questions need to come to mind. In this case, what is it? It feels like the tree. They're not in the business of selling fixed property and land, so this will probably be capital in nature. Okay, then we have scenario number 3. It says, on the 10th of January 2022, Artent sold goods to a customer for 58,000 rands, including VAT, on credit. The customer made an error and paid 85,000 rands when settling their account on the 1st of February 2022. Okay, so 10 Jan 2022, you invoiced 58,000 rands, and then on 1 Feb 2022, you received 85,000 rands. So you can see they switched the 5 and the 8 around for the customer. Now, what does that mean? It means you received more than what you invoiced. Now, my question is to you, the output tax that you raised, is it going to be on the 58 or is it going to be on the 85? Now, think about it logically. You issue the invoice for 58,000 rand, so this is what the output tax will be on the 58,000 rands. Because that is what the invoice was issued on. Okay, so, but they paid extra. So there's an excess. If I say 85 minus 58, there's an excess of 27,000 rands that they paid. Okay, now, immediately you need to start thinking about stuff. There's one rule that you should be aware of, and if you're not aware of it, you would have missed this whole section, and that's section 827. Section 827 says that excess, you must raise output tax if not refunded within 4 months. And that is from the day that you receive it. They received the excess here on the 1st of February. So February, March, April, May, the whole of Feb, the whole of March, the whole of April, the whole of May. So if by the 1st of June they hadn't refunded it, then they must pay on that 27,000 rands. They must treat it as if they invoiced that amount. So then you'll have to pay tax by saying times 15 over 115. The reason for this is because you have to, the invoice was only on 58,000, but you ended up receiving 85,000. So they're saying, listen, if it seems to us that you're not going to be refunding that, then it might be that you're invoicing low amounts and you've got some sort of agreement where you invoice a low amount, but the person pays you a high amount. You know, it might be something dodged. That's kind of the risk there. So they say you've got 4 months to repay it. If not, you must raise output tax on it. If you then repay it afterwards, you can claim input tax. So let's see here. So all of this, again, guys, is pure theory, pure a rule. If you don't know the rule, there's no way you'll know it in the exam. There's no way to figure it out. You either studied it or you didn't. Okay, so they tell you, when Artent discovered this mistake a few days later, it immediately contacted the customer to request their banking details to arrange for a refund. Great. The customer had, however, left to work on a project in the USA and could not be reached. So Artent placed the excess amount in a separate bank account, which is a trust account, to keep it safe until it could be refunded. Artent finally refunded the customer the excess on the 1st of July. Okay, so the 1st of June, you must refund by this date. But it was only refunded here. Only refunded here. Okay, so you can see on the 1st of June, section 827 will kick in. When you do refund it, then you can then claim input tax. In respect of section 827, is what I'm saying. Okay, so that's the one thing. Now, again, for VAT purposes we discussed, what is going to be the situation for income tax, gross income? Total amount in cash otherwise received by or accrued to a resident in the year of assessment, not capital nature, including a special inclusion. So now, in this case, we are entitled to 58,000 rands. But how much did we receive? But we received 85,000 rands. So, is our gross income 58,000 or is it 85,000? Now, you need to remember that one of the principles that we have to look at when you receive by, you have to ask yourself, are you unconditionally entitled to it? Did you receive it for your own benefit? Now, in this case, we have to consider it, that 27,000 rands excess, that we receive it for our own benefit. Are we unconditionally entitled to it? Now, the answer is no, we're not. But remember, what's important is there was a court case, and if you can remember the court case name, that might be a bonus mark for you. The Pyatt's case that said, if you receive money that is not yours, like a deposit, for example, you must keep it separate. Otherwise, it will be considered to form part of your gross income. In this case, we put it in a trust account. So that would mean that that amount, the 27,000, will not form part of gross income. All right, so that's it for question number 1.